Housing finance has risen, but so have the chances of a rate rise from some lenders, independent of the Reserve Bank. The big banks have made no secret of the fact margins are being squeezed because their own borrowing costs are going up. And with the election now resolved, many analysts are thinking it's a case of when, not if, they rise. Here's Simon Palin.
With rates on hold for the past few months and prices stabilising, appetite for mortgages is growing. Despite the expiry of the Home Buyers Grant, the number of first-time buyers are holding steady. And with this third monthly increase in lending, the analysts are talking up the property market again.
We expect that there will continue to be a significant momentum in the housing market. There's a lot of demand out there.
New figures from the Australian Bureau of Statistics show loans to build or buy homes jumped 1.7% in July, beating expectations. The demand, combined with recent falls in some bank profits, has some suggesting the big banks might raise interest rates independent of the Reserve Bank. The banks are finding their own borrowing costs are going up, squeezing margins, and analysts like Scott Manning at JP Morgan believe the best outcome for the bank's bottom line will be to pass that extra cost directly on to borrowers.
What we think they should look to do is increase the profitability on the existing book of mortgages as opposed to looking to grow the book of mortgages, and that will give a better outcome for shareholders.
It's of particular relevance to the Commonwealth Bank and Westpac, which have seen a drop-off in new mortgages.
They've gone from growing at twice system levels of growth at the start of the year to now be growing at system levels of growth, largely due to the constraints on their funding profile. What you've seen is ANZ and National Australia Bank go from below system rates of growth to actually fill that gap.
Despite the prospect of rate rises, the JP Morgan and Fujitsu mortgage industry report shows Australian households continue to favour variable rate mortgages. The proportion of new loans at fixed rates remains near record lows.
To be honest, the best loans are mostly variable. And to be honest, the industry is set up for variable loans. We're not like the US where they have 30-year fixed-term loans. It's just a very different market. I don't think we're going to see that happening here.
And the report also suggests that Australian banks are more than well placed to handle international reforms aimed at preventing financial shocks. A proposal by the Basel Committee on Banking Supervision requires banks to set aside additional capital.
In the Australian context, I think the amount of capital that the banks would need to raise under the current proposed requirements would be quite digestible.
But tougher licensing requirements for mortgage brokers could trigger a shakeout in the industry.
It could change the number of brokers in the marketplace. We could see some brokers leaving, and hopefully the quality of advice that's provided to consumers will actually improve.
The proposed regulations will become clearer in November.